Melissa's probably got to go and count some Girl Scout cookie boxes or put a sales pitch in front of us. Elise is going to come on.
Oh, yeah. I'm actually at drink, so that
Oh.
I can actually have a meeting without any interruptions.
One of my colleagues kind of does some of that behind the scenes for the Girl Scouts, and that cookie operation, that's kind of a racket. It's kind of a big old good racket. I'm like, wow.
Oh, yeah. Yeah, Elise loves doing her sales pitches. She loves it. So I think we're actually going to go door to door in the neighborhood for the first time too. So
take a picture. I'd love to see it. Doing her first sale at the door.
I will. She'll love it.
This is Melissa's daughter, so it will be live streamed, video uploaded.
Oh, yes.
I even think that Chinese balloon probably has a camera that's going to come shoot down on that. All right, that's it. That's the end of my comedy show.
Hello, I think it's 4 o'clock. I don't know if Brad's on or not. Didn't see his name in the list. So absent Brad, I guess by default, do I get to run the meeting? For this meeting, I think first on the agenda is to have BTC go through the year-end reports, and I will turn it over to Alan, John, and Jeff to go through that. Feel free to ask questions during the presentation, and then we'll go from there.
Can I ask before we start, did I miss anything? Were there attachments sent that I need to be hunting down?
I believe I sent the 1231 reports way back when we got them.
Oh.
Did I? If I didn't, I can send them to Rosie and have her put them out here as well.
Yeah, they should be in board docs.
Are they there? Okay.
Mm-hmm.
So I don't know who from BTC wants to start, and if you need to share a screen, you can do that as well. Barb, did you have a question before we get started?
Just real quick, the video link isn't on the board docs website. I've been receiving some emails that people can't get in because there's no video link. Just an FYI.
Okay, I'll fix that, but they should be able to use any of the last one. It's all repeating.
Okay.
But I'll fix that right now. Thank you.
Thanks,
I had the
Rosie.
same thing happen. Yeah, repeatedly over and over, and then all of a sudden it shows up and I can get on. So I don't know. Maybe they can now if they tried.
Okay, Alan, you want to take over from here?
Sorry, I was muted before. So I'll share my screen, and then John Augustine, our Chief Investment Officer, and Jeff Beardsley, the head of our finance. He's the head of finance. He's the head of fixed income. He's with us as well. So we'll go through the report. But what I want to do just to start out with is not follow up, but just a continuation of a discussion that Blake led last time. Was discussion about the possibility of increasing the equity weight in the asset allocation to 40%. Right now, the maximum weight that we can allocate to equity is 30%. And as you might recall from many of our conversations, equity is the primary driver of risk in the portfolio. So If we continue with that conversation, what you'll hear us emphasize or re-emphasize, just to keep in mind, I would certainly want the board to be mindful of this as well, that equity increases risk. So the more you increase it, the more you increase the risk of the portfolio. Well, what does that mean, or what could happen if, for example, if the equity market goes down 20 to 25%, for example, like it did last year or like it did during COVID, then that can seriously reduce the funding status of the portfolio. So, or the plan, not the portfolio. It would make the plan assets decline because equity would be an even larger portion of the total allocation. And as a result, it would make the funding status of the plan decline as well on its own. And if the market stayed down for a period of time longer than normal, that could be a serious problem. So that's something as participants that you want to be mindful of if we continue the discussion about asset allocation. From the district's perspective, I'm sure that's a concern as well. But the district, and I'm sure many of you are concerned about it too, but you also have headline risk. And that's something that, we want to point out. We see this with some clients. Some clients don't have headline risk, others do. But the school district gets in the news very easily, it seems like. And so I don't want that to sound negative or anything. I think it's just the Des Moines School District is a big, important entity. And so there are lots of people watching. And so we don't want to do something that creates undue headline risk. So I don't want that to sound too negative. I just want to put the points out there on the table so everybody's aware. Does that make sense? Any questions on that? Okay.
I don't know that I have a question, but Alan, I would just chime in and say, I think it's important for us also to acknowledge that we were a 90-10 and then an 80-20, within very recent history.
Yep.
And I think one of the things that I would encourage, and certainly anything you can provide insights on, is that, how have we seen the risk within the plan itself change even within the last 36 months when we've made those kinds of changes? And I think for me, that's where I look at this in two parts, is that shift potentially to a 60-40, it doesn't mean that we're going to land on a 60-40 mixture. I think for me, it's that question of empowering the BTC team based on, all the factors that we talk about, trying to achieve that minimum 5.78% earnings, if not better, because those are some of the targets that we've been really focusing on as we've provided members some sort of, background information and some projections to try to help make some decisions about changes or not making the changes. And so I just kind of throw that in there because I think it's important for us to weigh that too. Have we seen, was there headline risk when we went to 30%? Have we seen negative feedback from that? As Ms. Caldwell Johnson is on here, for her as a board member, has there been commentary from the community that has said, oh, you know what, when you went to that 30%, that was pushing it? And so I hope that I think all the way around, I think good notation for us, of what that means, but also what have we experienced the last 3 years as we've made changes from 90-10, 80-20 to 70-30 as well.
That can be part of the conversation if we continue the conversation, definitely.
Alan, I would have a question or a comment to add to that too. So, in Blake's comments, we have shifted from a 90-10 significantly over the past couple of years. Is there a mix where it's kind of the tipping point? So are we like our mix right now, if the market has some adverse reactions, are we enough protected? Whereas if we shift, by 10% or 15%, whatever that magic number might be, is there a magic number to keep us insulated, given our mix of retirees to actives? Because we do have to keep that in consideration when we're making these decisions as well.
Yeah, I would say that if there isn't a magic number necessarily, and if there was, it would really be dependent, or it would differ from client to client, or differ from, in this case, it's a plan. That's going to differ and depend on the characteristics of the plan and the pool. And you touched on it, Kathy. It's a blend of actives and retirees. And again, this is the question. There's 3 or 4 different things we would go into in answering that question, and I think that's, again, it's good material for it's good material to cover if we continue the conversation in future meetings.
Thank you.
And let me make sure I understand too. If we were to have a 60-40, that doesn't mean that we have to be 60-40, right? We could stay 70-30 if the market conditions seem to indicate that'd be preferable, right? Going to 60-40 doesn't mean that's what we would do. We would just basically loosen the belt so that we'd be a little bit more nimble as market conditions change, because we're trying to hit a target. Is that right?
We don't change the asset allocation in anticipation of what the market may do or what the market's done. So the allocation is dependent on the objectives of the participants. And so in this case, the participants, for the committee who's thinking about the participants and working in the best interest of the participants, they have to think about the whole spectrum of participants, from actives that may be, I don't know if we've got any actives in their 20s, but there's probably some in their 30s. And then or maybe even upper 30s or low 40s. And then there is a large proportion that are retirees and that are, I don't know what the age distribution is, but the point is that whole spectrum of ages and time horizons has to be considered. I'm sure, the actuaries can provide us with average time horizons for the participants, but bottom line is that's one of the key drivers in this. And so it's hard to make any single person satisfied, because you can't customize the allocation for a single person or a component or a small group of people within the participant group. You have to really consider the entire participant group. And so one group, anyway, it's a difficult conversation, and there's quite a bit of subjectivity that can come into play in doing this. Unfortunately, it's not as objective as it might be in other cases. And even in investments, there's just only so much objectivity. It's more of an art than a science. It's more of an art than a science in many cases. So does that help, Jessica? I know that doesn't necessarily narrow it down too much, but so with that, again, I assure you we can continue this conversation as we move forward with future meetings. For today, though, what we would like to do, and if we have time at the end, we can talk about this more. But for today, what we would like to do is cover the investment report, which has all the performance detail, the asset allocation detail as of December 31st. And so what I'll do is I'm going to share my screen. I'm getting pretty good at sharing my screen. Let's see here. Can you see it? Can you see the title page? I did it on Zoom today. I haven't done it on Teams yet today. So, okay, you can see it. Great. And now I'm going to, so we've got the title page up. Let me see here. Okay. So I'm just going to move to and I'm going to try to guide you with my cursor too. So if you can, I'll help you focus on what we're talking about by moving my cursor around. So in the upper left, this page is labeled compliance. So this has many of the guidelines, not all of them, but most of the guidelines that are specified in the plan documents that we are to abide by in managing the portfolio. So you've seen this many times. So for example, and I'm just going to hit the highlights because there's a lot of rows here, but the highlights are that cash as of December 31st was 2.1% of the portfolio weight, and it can be as high as 10%. We can certainly have 0, but it's normally around 2%, maybe a little bit less, and that's where it was to finish the year. So nothing to note there. Fixed income, that weight as of the end of the year was 70.7%. And it needs to stay within a range of 60 to 90%. So no problems there. Investment, it's very high quality being not only AAA to single A, which is specified in this row, but also triple Bs. Triple Bs are the lowest level within investment grade, and we've got some of that, but not a lot, only 12%. Most of it is very high quality AAA to single A. And then moving down to equity represented 27.3% of the portfolio as of December 31st. The range that the weight can be is anywhere from 10% on the low side to 30% on the upside. And we've been in the 26, 27, 28 kind of area for several quarters. So even though the equity market is down, we're still at a pretty high level within the equity allocation at 27%. Most of that is because we've had a concentration in value stocks, which did not go down nearly as much as the broader market in 2022. And I think John will touch on that a little bit among his other comments about performance. But this is a very value-oriented equity portfolio rather than a growth-oriented portfolio. And that made a big difference. It went down a lot less last year than the general market, and certainly went down a lot less than growth stocks. Most of it is large cap. So it's things like Procter & Gamble, Walmart. I don't know if we hold Procter & Gamble. We definitely hold Walmart, Google, Apple. That's 20% of the total portfolio is in those big company stocks. Small allocation, 2.4% to small caps, a little bit of real estate, less than 1%. And then international stocks at 3.8%. So a small allocation there, but the bulk of it is the equity performance is going to be driven by large cap stocks. And then to finish things off, we've got some miscellaneous guidelines that we abide by. And there's only one that I want to touch on here, and that is the investment in any one corporation. So what this means is, if we look across the portfolio, we look at, for example, how much do we have invested in Walmart, not only in stocks, but in bonds? What's that total amount as a percentage of the total market value of the portfolio? And as of December 31st, it was 1.9%. And you may recall from prior quarters where we're always right around 2% in Walmart. We've got bonds and we've got stock. So it performs well, it holds up very well in difficult markets, and it produces good cash flow no matter what the market environment is like. So nice, solid, we keep a pretty big weight in it. And that's what the 1.9 is. And that's the closest market value that we have to any of these guidelines. And so that's the one I want to point out. Everything else isn't even close to the guidelines over here. So this is all in good shape. We're in compliance with all the guidelines in the investment policy statement. So there's no need to rebalance. There's no need to buy or sell anything in order to bring the portfolio into compliance. It's already there. Thoughts or questions on any of that before we move on?
So Alan, you addressed this during the last meeting, but I want to bring it up again. One of the questions that I asked was whether the BTC team had any concerns or any thoughts on whether any of these limitations should be changed, whether we were to kind of use Jessica's term, are we creating anything that tightens in such a way that maybe some looseness would be better? I think you answered this last meeting saying that those other limitations really weren't, primary drivers, but I just want to sort of confirm that as we see it on the screen. Are there any of those limitations that we should be looking at and revisiting what they should or shouldn't be to best impact growth in our plan?
No, nothing comes to mind, Blake, and that's based on conversations that we have internally, not only among the investment team talks about these things in managing portfolios. What's constraining us? Gee, this guideline, if we could widen it, then we could buy more of X. That would help. Sometimes that comes up, and with this portfolio, we're not coming across that, and I think it's mostly a product of not because we're not having the conversations, but we are, and we're reviewing the guidelines in the investment policy statement. But the thing is that really helps us here is that we've been managing this for over 20 years. John, I think it's over 25 maybe, and so we are very familiar with what the guidelines, what constrains us and what doesn't. And over time, I think things have been there have been many adjustments over time. And so equity, increasing that equity weight from 20 to 30%, that was the latest back in October 2019. But before that, everything's been tweaked, Blake, to the point where we don't feel constrained by anything that's going on here. So.
Thank you.
Okay. We will move on to the asset allocation page, and I will let John take it from here, and he's going to take us through the next couple of pages. Jeff is going to touch on fixed income, and then John's going to finish it up. So I'll leave it to these two guys.
Okay, thank you, Alan. Can everyone hear me? Can anyone hear me?
Yes, we can hear you.
I think we're good, John.
You're live.
There was kind of that pregnant pause there. I wasn't sure. So just starting out on page 3, this is just more of a graphic representation of the allocation as it existed as of December 31st, 2022. You can see once again, just kind of reiterating what Alan has already touched on, is the majority of the assets being held in investment grade fixed income, high quality, permeating that entire portion of the portfolio. And then the various breakdown of the equities, about 20% in domestic large and mid cap stocks, about 2.5% in domestic small cap, a smaller allocation to REIT, and then foreign developed about 4%. So once again, just to give you a little idea of the further breakdown between the equities and the fixed income, to give you some further information on that front. Moving to the next page with the performance as of December 31st, very unusual year, and Jeff will echo this in a moment in terms of fixed income. To see equity and fixed income markets both decline at the level that they did in 2022 was extremely rare. It just doesn't happen. I think the lowest return for the broad bond market was 1994, going back, 40 plus years, was 1994, and it was maybe something like 3%. So to see the bond market in terms of the Bloomberg Aggregate Bond Index have a negative 13% return was once again a very, very rare event. Also to see once again equities and fixed income move in the same direction to the magnitude they did was extremely rare. So you can see your 1 year return minus 12%, your benchmark was minus 11.5%. So as we kind of walk through the various asset classes, you can see cash and equivalents, that's basically money market fund. We did see improved performance there because we were starting from pretty much just barely above zero to where you got a return over the course of last year of 1.8%. Fixed income down pretty much right at 13%. Once again, very, very unusual to see that kind of performance from the bond market. Once again, as I've pointed out in prior meetings, you do have some municipal bonds, but they are not tax exempt, they are taxable. But because they're municipals, they get labeled that way. A little lower return from them at about 15%. And then when you look at the domestic equities, minus 8%. And want to kind of highlight that because for those of you who have been on the committee for a while, you'll know that for a number of years, we really focused on domestic value stocks, primarily because of the additional income we could generate relative to the overall stock market. So as interest rates declined, we migrated more towards the value portion of the equity markets to generate more income to offset the decline in the interest income we were getting from the fixed income portion of the portfolio. So you can see the benchmark there is the USA Value Index. So a little misleading because, as you know, we've added some other equity asset classes to the portfolio over the last couple of years. We've added some small cap, we've added some international, and we've added some dedicated real estate investment trust exposure, or REITs. So when you take a look at how the overall equity market did here in the United States last year in terms of the large and mid cap stocks, it was down about 19.5%. So when you take that into account, being down 8.43 is pretty significant in terms of having that much better performance than the overall stock market. And that's what that emphasis on value stocks did for you last year. As you take a look through, you can see the foreign equities lower performance, although foreign equities in aggregate did better than US stocks in aggregate when you take a look at the very broad indices. So having that exposure was actually helpful relative to the overall equity market here in the US. And then, of course, we did have the REIT exposure. REITs were actually one of the poorest performing sectors of the equity markets last year. When you take a look at the real estate sector overall, in terms of its performance, down about 26% last year. So the reason we included those REITs over the last year or 2 years was once again to enhance the income being generated in the portfolio. And you'll see that's still the case when we review the REIT segment of the portfolio individually and see the contribution it's making on that front to the portfolio. So once again, overall, extremely unusual year to see stocks and bonds move as negatively as they did. The value portion of your portfolio on the equity side was a real nice exposure to have, given how well value outperformed growth and the market overall. And that's why you see such a nice return, which it's not really appropriate word to say nice at minus 8.43, but compared to the overall equity market at about minus 19, that was a very positive experience in that regard. So are there any questions about the performance before we proceed? Okay, if not, I'm going to turn things over to Jeff Birdsley to tackle an overview of the fixed income characteristics of the portfolio that are represented on page 5 of the report. So Jeff, it's all yours.
Thank you, John. What we have, as John mentioned, last year was an unusual year with the bond market down as far as it is. I think you have to go back.
Can you speak up a little bit, Jeff?
Yeah.
You're a little bit faint, or put your microphone a little closer to your mouth. There you go.
There we go. How about that? And
Crank it up a little bit.
And I think I'll make sure I get a little closer here. Sometimes it doesn't use this mic. It might be using the mic on my.
Oh, okay, got it.
So sorry if I'm leaning in a little. It's like mealtime. At my house, we had a lot of kids, so we had to lean in a lot. So you can see the yield to maturity up there has climbed all the way up to 5.26%. That's the current yield on the portfolio if we sold it today and bought it back. Relative to the benchmark, that is higher, and the reason for that is we do hold more corporate bonds than the benchmark, as you can see even further down the page. Average credit quality, very high, A1 on average compared to the benchmark, which holds much more treasury bonds than the portfolio. Average maturity, a little bit longer than that of the benchmark, but fairly in line on a credit risk basis, with the effective duration being 6.26 versus 6.13. That's really the more important number, as it measures the interest rate risk in the portfolio itself. Down below is a breakdown of what we have in the way of asset holdings, as Alan is marking off there. Most of our holdings are in corporate bonds. We do own municipal bonds. Those are taxable municipal bonds. Majority of those are taxable municipal bonds, and they are offering rates, very high credit quality. They're AA and AAA rated municipalities, and offer really good yields in today's environment in comparison. One of the things that we have been looking at adding a little bit more is to the mortgage-backed securities area, as value has returned to that segment of market after many years of not being there. Average credit quality, again, very high. As you can see, the distribution of credit quality pretty much even between AAA and AA there, and moving down the group there. We do have one holding. We have two holdings that are below investment grade. One is Apache Oil, which recently did get an upgrade from one of the rating services, but because 2 of our 3 had him still in the BB area, we continue to hold it there. We do see that improving that credit. And then there is a long-standing position in a Fannie Mae preferred that is illiquid to a certain degree, but still carries some value and may at some point, hopefully in the future. With that, again, the key component of the fixed income is to achieve a level of that sustainable portion of the portfolio that sustains the payouts. The equity portion is to develop and build capital over time. And I think that's a key component of what you were talking about earlier, what Alan was pointing out, is the equities grow the portfolio, the fixed income provides that generally provides that constant return and lower risk component. We do expect 2022 to continue to follow, 2023 to continue to follow a positive path as it has in the first month of the year. And we do expect there to be positive returns out of the fixed income market in 2023. So we do see a pretty abrupt turnaround from that minus 13% to to a more traditional return posture in 2023. With that, I think the equity portion comes up after this. So I'll turn it back to John. Thank you.
Okay, thank you, Jeff. And we'll start by taking a look at the large cap value segment of the portfolio, the equity portfolio, which this is the largest component of your equity holdings, and kind of touched on a few moments ago why we had transitioned to emphasizing value so much in the portfolio. As you take a look in the upper left-hand corner, and I think many of you are familiar with this format, you'll see some characteristics as of 12/31. With this strategy, we really do try to maintain a pretty modest valuation as suggested by the price earnings ratio. And you can see at the end of the year, it was at 13.6 versus the benchmark, the MSCI USA Value Index of 16.1. The other metric we really focus on in this strategy is dividend yield. And you can see as of 12/31, the yield was 2.6% versus the benchmark at 2.4. So we really try to maintain that higher yield while keeping the valuation modest. And you can see that's how the portfolio or this section of the portfolio was positioned as of 12/31. The sector breakdown listed there directly below, so you can see an idea of the representation of the portfolio relative to its benchmark. And you can see the most extensive exposures are financial companies. That is the biggest component of the value index, along with healthcare. So significant exposure there. And in the lower right corner, you can see the top 10 holdings as of the end of the year, represented by, in many cases, names you're very familiar with, like Home Depot and Pepsi and Johnson & Johnson and Walmart, and as Alan referenced earlier, Procter & Gamble. So large, well-established dividend-paying companies that are generating in aggregate a yield that is higher than the benchmark, which is one of those metrics that we're always trying to be aware of and on top of in terms of positioning relative to the benchmark. Next page takes a look at the small cap portion of the portfolio. Once again, those characteristics in the upper left-hand corner. You can see in terms of valuation, we're pretty much right in line with the benchmark. But we do have a higher dividend yield at 1.9% versus 1.4%. And once again, the sector breakdown, and then the top 10 holdings in the lower right-hand corner, not as well known as those we saw in the value strategy. So a little more dispersion when you take a look at the small cap, where there's a lot more companies, and none of them have the significant presence that many of the large cap companies that are in the value strategy that we just touched on. Moving on to the next page, taking a look at the international strategy. And just as a reminder, what this is comprised of are what are referred to as ADRs, American Depository Receipts. So these are shares of international companies that are represented by receipts that are traded here in the United States. So as you take a look in that lower right corner, you see some of those companies from around the globe. And basically what we're buying and selling are, once again, American Depository Receipts that are backed by the shares of these companies. But the key difference is these are all traded on domestic exchanges. So we don't have to worry about trading in London or any other markets around the world. Everything we buy and sell is traded here in the United States with these receipts that are backed by shares of these internationally domiciled firms. Just taking a look at the characteristics here, you can see the price earnings ratio, and you can see relative to the domestic market, the valuation is less expensive for the international equities, PE ratio of 9.9 relative to the benchmark of 12.5, and then a better dividend yield, 3.3% for the international equity holdings. Once again, we added this within the last couple of years to provide more diversification, potential growth opportunity, but also, as you can see from the dividend yield, to add some meaningful yield to the portfolio from the equity side as well. So once again, not as familiar in terms of that list of top 10 companies. Unilever, a big consumer products company where a lot of those products sold in the U.S. Nestle, the chocolate company, obviously, we're all familiar with that. So with that, I'll turn to the next page, which looks at the breakdown of the real estate component. As you saw earlier from the asset allocation, it's not a big component of the portfolio as of right now, but once again, we did add some exposure here, primarily because of the significant yield that this part of the market makes available to investors. So if you look in that upper left-hand corner, you'll see the dividend yield as of 12/31, 5.4%. So very significant compared to those other segments of the equity market we just looked at. Now, the downside of real estate last year was it was one of the most poorly performing sectors in the equity markets. If you look at just real estate within the broad U.S. domestic market in terms of large and mid-sized companies, it was down 26% last year. So a meaningful decline that was experienced in the valuation of, or the value of these holdings. Once again, though, some nice dividend flow. And so far this year, this sector is up 9.9% year to date, where the broad market is up 8.9%. So we are seeing a rebound in the prices of these underlying REITs that are held in the portfolio. We've seen that more broadly too in the market. Some of the names that were beaten up the most last year have had some of the strongest returns so far this year. So it's been a very interesting development in just a little over a month into 2023 to have a return as significant as we have. A very pleasant surprise, and we'll hope that momentum continues as we go through. It'll be interesting to see if that truly does materialize in terms of keeping up this pace, because we do see declines in earning estimates for corporations, and so that will be a factor as we move forward. But once again, we have seen a nice rebound in the real estate holdings, and once again, they are continuing to pay a very nice yield to the portfolio. And with that, that's all the comments I had on performance. Once again, certainly happy to entertain any questions you might have.
Okay, hearing no questions, you can move on to the next item on your agenda. If you do think of questions, feel free to route those to us through Kathy, and we'll get back to you as soon as possible, or there's always next month as well. So either way, we just want to get your questions answered.
Absolutely.
So let's see here.
Thank you so much. Rosie, can you pull the agenda up, please?
Sorry, do you want me to share it?
Yes, please.
Okay.
Thank you. So the second thing on the agenda is the committee recommendation. I'm assuming that is referring to the recommendation based upon last month's, or last, wasn't a month ago, it was just a couple weeks ago. Blake had sent the recommendation of the committee to increase the employer contribution. In full transparency, due to some system-related issues, as I'm sure you can all understand and appreciate, that has been a little bit more difficult for me to put costing around. I think I have it pretty well wrapped up as of, I've got about 3 more people I need to look up and get salaries for. We just didn't have the ability to look those up previously, so now I can do that. And I should have that costing available for Matt and Shashank to review. And then from there, I will keep you posted on if they will be advancing that to the board, or if this committee itself needs to advance that to the board. Are there any questions on that portion of the agenda? Okay, we're just zipping right along. All right, the next one, plan document revisions. I know we've talked about this in previous meetings that our plan document is not only out of date, perhaps there are some things in it that we aren't necessarily following or doing in a different manner that need to be reflected correctly in the plan document. And we had talks about meeting in a smaller group to go through that. And then we talked about, let's just start tackling it at maybe one piece at a time with the full group, I think was the last discussion. I'm wondering if we need to like assign pre-reading for everyone of, read sections up to the following sections, and then we'll discuss that in the following meeting. So people are prepared to come to the meetings ready to discuss rather than just jumping in and people not being familiar with the document. Thoughts on that? I see Melissa shaking her head.
I like that idea. And can you send out the most recent plan document? I'm sure I have it somewhere, but I'm looking through my files and I'm not sure if I put it somewhere or.
Yeah, what I can send is the plan document, and then added in that file will be some amendments that we've made to the plan document that aren't necessarily reflected in it, but have been done by amendment. And that way you have all the most current information as we start to discuss and digest our plan document. And Blake, I am not in a place where I can pull mine up, and I know you've got yours just handy dandy right there because I know Blake Hammond.
I actually don't have it right in front of me, but I can get to it in about 5 seconds. So are we trying to think of where a marker point is to stop?
Yeah. Yeah.
1 second.
Blake and I have been working too long together when we can read what each other are thinking. I think it's a good thing.
I can just tell you the first section, Article 1 is definition, Article 2 are eligibility and participation.
I wonder if we don't try to go through in terms of the reading homework, if we would go through Article 4, which would
Okay.
end on page 19. And I say that just because a lot of what's in there is kind of like Barb was saying, this is more definitions, background. And I don't, there are some pieces that we certainly need to talk about, within some of those definitions, but it's really sort of the nuance of who actually is doing what. I don't know that there'll be a lot of changes, but I wonder if stopping at Article 4, which again stops on page 19, gives us that's a pretty good bite, but I think is enough that is manageable within, 20, 30 minutes of realistic conversation at our March meeting.
That sounds good to me. So through section 4.
Yeah, Article 4, which goes to page 19.
I will send out the plan document, the amendments, as well as the plan to read through Article 4 for our next meeting, and then we'll start to review and discuss in the next meeting. Does that sound sufficient?
Yep, sounds good.
Thank you.
Okay. All right. And do we have a next meeting set, don't we? Let me just make sure that that's on a calendar here.
And we March 8th at 4, I hope.
I'm just making sure it's already out there. Yep, it's out there on the calendar. I just wanted to make sure that. So March 8th, everybody's got 19 pages to read by then. That's a pretty easy instructors we are over here. So, all right. Well, if that's it, Thank you, everybody, and we will convene again on March 8th. Prior to that, if I hear anything, I will let you know regarding the recommendation, and I should know something before March 8th. Okay,
Thank you.
thank you, everybody.
Thank
And
you.
congratulations,
Bye.
everyone. You got approved by the school board. So you're all official.
Oh, yes. Oh, and I need,
Oh.
before we go, before everybody drops off, Blake had sent me a name of an active participant who was interested. I need to find out, I need to look through and see if we can appoint or we have to go through another election to get that person on. I'm not sure exactly what those procedures are.
Yeah, I would say, Kathy, reading the plan document, it does not clearly define that.
Well, I kind of glanced at it, so that's what I'm thinking. So my thoughts are, should this committee move to approve that individual, and then I can get it on the board?
That would be my thought, is that we would move, make that motion, and knowing that that person then, whenever is the next election, would automatically be up, which would be correct anyway, as a 1-year term.
Right.
I'll look more carefully at the plan document, Kathy, on that specific issue, and I'll let you know if I see something otherwise, but I've read that before, and it seems like it doesn't really define.
It was pretty
in the
silent.
Right.
Okay. I looked for it and didn't see anything that was glaring to me, but I didn't give it as much time as I probably should have. And so I wanted to go back and look also. So in our March 8th meeting, Rosie, if you want to put that on the agenda for the March 8th, as well as the plan document review, and then the election or discussion of the vacancy for the active membership on the committee.
Okay.
Thanks, Rosie. All right. And Rich, look at Rich. He's already moving and approving this individual in the chat. Way to go, Rich. All right. Thanks, everybody. We'll see you on the 8th.
Thanks, BTC team. Appreciate it a lot.
Yes, thank you.
Thank you.
Thank you.
Thank
Bye,
you.
everyone.
Bye-bye.
Bye.